Hello viewers, today we'll talk about if you have a mortgage, should we pay off the outstanding mortgage amounts or should we instead invest the money into some stock market or other investments. So there are different perspectives. Certain kind of people may not like to have big mortgages or big loans in their account, and they feel a lot better paying off this big amount of loans. Or certain people, depending on their risk appetite, they might like to pay off the loan and invest the money, the proceeds from some other investments where one could get better returns. So it depends, and since the mortgage products are somewhat complicated, so there are some kind of mathematical aspects when it makes sense to pay off the mortgage versus when to not pay it off, and then or instead of make investments and alternative investments. So whenever you take a mortgage, it's a very long-term loans. It could be perhaps one of the biggest loans one could have taken, and the payments, the monthly payments, say if you have a 30-year mortgages, the amount payment is basically divided into two parts. One is the principal payment and one is the interest payments. So the overall payment is some amount will go towards the principal, meaning like paying down your outstanding amounts, and rest is basically go towards the interest payments on these loans. At the initial phase of the loan, the interest pay amount dominates the overall payments. In fact, it could be even 90% or even more of the overall payments towards the interest payments. And as you keep paying down, the interest payments keeps going down and the principal payment keeps going up. So the lenders at the beginning period, they basically get most of their interest payments collected at the initial period of the mortgages. So if you could pay it off mortgage earlier, potentially you could actually end up saving a lot of money by not paying on the interest. But there are various things you have to consider before you pay up the interest payments. First of all, to pay up the interest, you have to have enough funds to pay off the mortgage. Usually 62% of the population here in the United States, they are basically like paycheck to paychecks. Not too many people are having solid savings to pay off the loans. But if you have, congratulations, you really have accomplished a great deal financially for paying off towards the loan. So the other things you have to consider, should you be paying off these loans? The first thing is, once you pay off the loan, there are some pros and cons you should consider. The pros would be you could save money on the interest. So if you are paying the interest payments, if you pay it off the loan, you do not have to pay the interest payments anymore. So you'll be paying up the loan and you have one big amount not to be paying anymore. Second thing will be you could free up the money later on, and you could use it for something else. Maybe you want to go on a vacation, or if you would have another ideas by saving those money down the line, you could use something else. Or you could increase your home equity on your property, because once you pay it off, you would basically slowly the home equity will be building up, and once you pay it off, the house will belong to you, and the bank will not have any liens on you. So you will be totally the owner of the house. In terms of the cons, so one thing would be you will have less money for higher interest rate debts. Say for example, if you had credit card debts where you could be paying up to 20% during this holiday time, if you pay off all your money on the mortgages, you may not be able to pay the higher interest rates loans, because you should actually always try to pay off the those loans with the highest interest rates, because you'll be paying off big amount of money as the interest rates are higher. So if you do not have your money by paying off the mortgages, you may not have enough money to pay off for your credit cards and other high interest rates loans. Second thing would be your savings. If you pay off everything, at the least you should have some emergency funds. You should at least have your 6 months of your savings, 6 months of your expenses. If any kind of emergency situation arrives, say for example you might lose your job, or some kind of unforeseen situation, and then if you have to do some kind of fire sale, if you have to sell off your stocks and other assets at a low price, it will be pretty negative impact it could have if you're in this kind of situation. So you should always have the emergency fund before you can pay off your the mortgage loans. The third thing could be you might be missing out any opportunity if the higher products, say for example if the stock market is picking up, but if you pay off all the money towards the mortgages, you may not have enough money left to invest in the stock markets. So those are the pros and cons I just described. And also there could be some kind of tax implications, because if you pay the mortgage amounts paid down, so all these the property taxes, then other things that the mortgage interest rates, this could be you have tax benefits. You may not have the tax benefits anymore once you pay off all these your loans. So before you pay off these mortgages, there are certain things you could ask yourself before actually if you decide to go ahead and pay it off, or even if it's necessary, please put up a spreadsheets, do some math and get the numbers, whether it makes sense or not. The first thing would be you have to basically check that you don't need the money anymore, because once you pay off, and if you're not left with any more money, if you have to basically get a home equity loan, it could be more expensive, because home equity loans could be more, the rates could be higher, or if you do not have good credit rating, you may have difficult time getting another loans. The second thing could be the mortgage rates. If your current prevailing the mortgage interest rates, say for example 3%, initially last couple of years people used to have very good mortgage rates, and if you want to pay it off, then the amount the money that you're paying off for the interest, that's kind of as if you're saving for yourself, versus if the current stock markets typically gives around S&P gives you around 9 to 10% return. So after getting if you pay the taxes, so you might be remaining say 6% appreciation of investment. So it makes sense. So you'd be making 6% if you invest, but versus if you pay the mortgage loans, you could only be saving 3%. So it doesn't make sense. So it makes sense if the mortgage rates are higher, and if you can pay it off, because it is difficult to get very high return from the stock market after paying tax to beat the number from the mortgage rates that you have been paying, the mortgage interest rates. So these are the two things you could very important point you should consider. The other thing is how much do you really care actually being debt free? I mean that you do not have any more mortgages. There are a lot of people, they feel pretty free once their mortgage amounts are paid off, and that's a brings you a lot of happiness. Maybe it makes sense for you to pay off the loan rather than like investing the money into like stock markets. So it depends on personal feelings, how one feel about like taking risk versus not taking a risk, and be like free of paying the mortgage. So once basically if you decide to pay off the mortgages, there are many different ways you could optimize paying off your the loan. The one thing could be you could create a budget and say every time you pay the mortgages, you can make some extra amount. And if you make an extra amount, your the overall like the period that you have to pay the outstanding loans, it will shrink. The amount of loans will say, for example, if you had a $250,000 loan at 5%, and if you make like extra payments of 20 extra payments, so your payment it will reduce by 8 months and save you about $5,700. Another second thing is you could do is make extra payments. Say for example, if you have some kind of like bonus at the end of the year, or if you had like in April, if you get like a lot of like tax return from after you pay taxes, you might want to make one or two like big amounts payments, so that your the overall outstanding amount reduces. So that will shrink the overall payments, the time period of the loan. That is one thing you could reduce, and that will also reduce your interest payments. The third thing you could do is refinance your mortgage for a short period of time. Say for example, if you had a 30-year mortgage loan, and if the interest rate is favorable, say if it comes down, and if you take a shorter period of loan, say if you had a 30 years loan versus 15 years loan, say if the earlier 30-year loan was at 3%, and if you get like a 2.25% loan for 15 years, the total interest amounts, if you take like $250,000 loan, if you pay a 30-year loan, you'd pay around $129,000 on interest payments. But if you switch back to, if you refinance to 15-year mortgage, you will only pay $44,000 interest payments, meaning you'd be saving about over $80,000 or $85,000 on the interest payment by switching to a short financed mortgage rates. Other thing it could be, there's something called mortgage recasting. The recasting is one thing is that if you pay a big amount, the terms of your mortgage will be recasted, but only certain kind of mortgage they could be like recasted. Say for example, FHA loan or like VA loan, they cannot be like recasted. Another most important thing is like another strategy you could use is that instead of monthly payment, you could do bi-weekly payment. Whenever you do like a monthly payment in a year, you pay 12 payments once every month. But if you pay off like say every 2 weeks bi-weekly, you will end up paying 26 payments. 26 multiplied by 2 is 52 weeks. So in effect, you will make one extra payment instead of 24 to 26, 2 extra 2 weeks payments, meaning like as if like 1 month extra payment you do. But that will actually shrink the overall duration of your mortgage by a significant amount, and will save a lot of money by paying the bi-weekly payment. Say for example, if you had a $250,000 30-year mortgage rates and 3.5%, you could pay off on $20,000 of loan, and you can cut your mortgage payments by 4 years by doing bi-weekly payments. So that's the benefit. So these are all these things you should consider basically before you can pay off your the loan. And what happens once you pay off the loans? Basically, once you pay off the loan, the lender or the bank basically they will not have any more loans. And basically that you will have the complete, like, the owner of your property, the where you had the mortgage on. And the bank will send you have to sign off all these papers and everything. And you don't have to, the bank will pay off all the outstanding, like, escrow amounts, but you will be kind of responsible to pay off all the property taxes and homeowner insurance once, basically, like, you completely pay off the loan when you become the owner of the property. So please, hopefully you found this video a little bit helpful. If you did, please do subscribe it. And thank you very much. Nice to see you and have a nice day. Bye bye.